Yo, what's going on? Welcome to the Market Chat, and it's my first video. Today I'm going to tell you about Rowe Price, my current favorite stock in this market sell-off. So, as many as you know, I bet you know the name of Rowe Price, but if someone asks you, you probably have heard of it, but if they ask you again, you would have no idea what they do. So, just a little Google search. What does Rowe Price actually do? No, I don't care about the balance sheet right now. So, from their website, this is what they're telling us. So, personal investing is what they offer. They offer workplace retirement. They also take money from institutional investors, and if you don't know what that is, you should probably look it up. They have financial advisors and intermediates, and they also have record-keeping sponsors and consultants. You should probably look up what that is, because I have no idea. Anyways, Rowe Price is a company that is going to help you retire. They're going to give you tax advice. They're probably going to sell you insurance and offer you insurance. Looks like they do some institutional investing, which means that they take large amounts of money and they have to put it to work. So, Rowe Price is a subsector of the financial sector, also known as the XLF. And within that sector, they're the subsector known as capital markets. Think of this kind of like the JP Morgans, the Morgan Stanleys. Think about Blackstone, BlackRock. They're a company that isn't particularly a bank, but they deal in finance all day in the fact that they move around massive amounts of money. So now let's go back to Rowe's chart. Big sell-off since November. Let's get the percentage on that. We're taking it from November 1, the top, down to the close of June 10th. And it was a bad week. Rowe's down 8%. And that brings us down to a negative 47.9% decline since it peaked back in November, which is huge. If you had $10,000 in this, you're looking at, $5,000 and maybe $200, just getting crushed. So now let's see how it's doing compared to some of those other stocks that I mentioned before that are also in the subsector of the financial sector known as the capital markets industry. So let's go JPM. Let's take a look at JP Morgan. When did this thing peak? So JP Morgan it actually peaked a little bit earlier. Rowe peaked back in November. JP Morgan peaked on October 25th. So this one led in the case to the downside. JP Morgan also having a bad week with a very similar percentage decline of 8.15%. And since that end of October peak, we are now down 30%. So Rowe down 45, JP down 30. We're clearly seeing that the market does not like Rowe as much as JP Morgan in the fact that JP Morgan has held up better in terms of relative performance when compared to Rowe. So we looked up JP Morgan. Let's look up Morgan Stanley next. And just from looking at this chart, you can clearly see how much better that Morgan Stanley has held up compared to both JP Morgan and Rowe Price, just based on how much tighter this move down looks. We saw that big sweep down on Rowe. We got that same sort of pattern on JPM as well, but to a lesser extent. So let's check this one. So this one actually peaked on February 7th of 22. So, Rowe, that one peaked in November. JP Morgan peaked in the end of October. And then this one peaked almost 3 months later, in November of 22. So let's take it down here. Even though this move is of similar magnitude to JP Morgan's, we can clearly see how much more volatile that Morgan Stanley is, because this percentage move drawdown is the exact same as JP Morgan's, but the move on the chart looks much smaller. So that's something you need to think about as well. So Morgan Stanley actually doing the best, holding up. Let's look up Blackstone. This one peaked in November as well, and in November, about the same time a little bit, couple weeks after Rowe did. Let's see, this one down 27%, kind of in that same pattern as Morgan Stanley. This one's a little bit looser. You can tell it's looser because you see this kind of head and shoulders pattern forming. We didn't really get that on Morgan Stanley as much as we're doing here. So much looser range. Morgan Stanley's been much tighter, less volatile in that sense. And then finally, let's look at BlackRock. This one looks much more like T-Row's. Let me get rid of some of these for you. Oh gosh. All right, so into this one peaked. This one peaked in the middle of November, kind of the same time. Looks like all these, peaked within a couple weeks, couple months of each other. So that's something to take note of as well. If you're new to the markets, you got to kind of know when sectors are moving together, and then when stocks within a sector are moving together, and you'll often see they peak at the same time. This is kind of just due to, the invention of ETFs is kind of a way to think about it, as a reason that many of these stocks move together. Because if you own an ETF, you own a basket of stocks, and if you sell the ETF, then you have to sell, the ETF itself has to sell those stocks. So, you may be just bearish on, one stock within that sector, but if you own a large sector fund, you indirectly have to sell off all of them. But that's a whole different topic for discussion. Now we see BlackRock. This one's down 35%. So of those kind of capital markets that I looked at, T-Rowe was down the most. So that's something to take note of. Next, the reason I like T-Rowe is because I want to add it to my Roth IRA, where I am doing dividend growth investing as my current strategy. A lot of people say, your Roth is supposed to be for growth. If you're getting all these unrealized tax gains, it's best to compound them within your Roth because you won't have to pay those gains. But you can't touch that money until you're 59 and a half anyway, so you might as well just kind of use it as a business more or less. I wouldn't mind paying taxes on these huge wins because you can roll that into something else much easier than you can if you are investing within a tax-sheltered kind of brokerage account. You will have to pay a penalty if you take that money out before you're 59 and a half. So at this point, I'd much rather use my Roth to kind of compound these dividends tax-free. And what I'm really trying to do here is double my money every 3 to 5 years. So what that means is I'm looking for stocks that offer a decently high current yield, starting yield of when I purchase them. So let's see. T-Rowe's sporting a 3.9% yield. That may be a little bit out of date. I pulled these numbers a couple weeks ago. But it shouldn't be too far off that. Next, I'm looking for stocks that can grow their dividend. So how you know if a stock can grow its dividend is you have to look at its payout ratio. The payout ratio is what percentage of the stock's current earnings within a certain, in this case, it's the last trailing 12 months, are being paid out to its dividend. So if you have $1,000 that you get in earnings, T. Rowe Price is going to pay its investors $364.40, representing 36.44% of its earnings are going towards the dividend. So that means that $64 or 64% is reinvested into the business, sitting in cash in the business's account, used to buy shares back of the underlying business, known as share buybacks, or it is being used to fund mergers and acquisitions. Say T. Rowe wants to buy a smaller chain of non-publicly traded or even publicly traded, financial advising firms. That's what they are using that 64% of the earnings that are not being paid out to the company for, or to the shareholders for. So, with a low percentage term of dividend paid out in terms of earnings, this means that if they wanted to, they could realistically almost over double the dividend just through the payout ratio alone. So, if they're paying out 100%, none of all of the company's earnings are going towards the dividend. Like there's literally no money going into even the bank that the company has. 100% of that money is going to the shareholders. So the easiest way to raise your dividend if you have a low payout ratio is simply pay a higher percent of your earnings towards the dividend because you can cover it. So that's what I'm looking for is a lower-ish, like for these capital market stocks, I really want a payout ratio. I'd say below 50%. 60% is kind of the higher end, just because in some ways these companies really don't have huge moats. Their biggest moat is just having the smartest people in the room and just pure marketing. Like they're not going to be a consumer staple company like Coca-Cola. You don't really switch back and forth between Coke or Pepsi. Like you like one or the other. But if you aren't happy with your financial advisor, it's a lot simpler to kind of just pull out and go somewhere else. So that's why I look for these lower payout ratios, just because I know that money will have to be reinvested into the business. And then the next thing I'm looking for is the dividend growth rate. So this is the 3-year annualized compounded dividend growth rate. So over the last 3 years, it has averaged 15.55% increases. So 1 year, it goes up 15%, and then it goes up 15.55% again, and then the third year it goes up 15.55% again. So, like I said, I was looking for companies that I could double my money in every 3 to 5 years. And as we know, the rule of 7.2, if you get a 10% return, your money will compounded, your money will double every 7.2 years. So let's say you're looking for a 20% return, then theoretically your money should double in about 3.5 years or so. And this is kind of the sweet spot in between, so we're looking at about 4.5, maybe 4.25 on this to double our money. Next up, those are really kind of the biggest ones I'm looking at. And I like to look at EPS growth because the easiest way to grow your dividend is to make more money. So if you're making 21.14% more than you did last year, it's super easy to increase your dividend by that amount of money because it makes sense. Like you have that money, you're not paying it all out. It's very easy to grow your dividend if your EPS is growing at the same rate. Next one is debt to equity. So I don't know why, but a lot of people think T. Rowe has a debt to equity of 0, and you'll find that if you just do a simple search, but that's why I had that balance sheet pulled up earlier. So everyone knows debt to equity is total liabilities divided by your total shareholder equity. So we're looking at 3 divided by 9. So that's about like a 33% debt to equity, which is good. That means that the company has less debt than the total shareholder equity, and equity is assets minus liabilities. So if in event, there's not a real big chance that this company is going to go insolvent. Next up, I look at return on equity, which return on equity is the net income divided by the total shareholder equity. And this is kind of, a way to look at internal rate of return for a company. If they didn't pay out any dividend, if they reinvested 100% of their quarterly earnings or yearly earnings back into the business, this is a theoretical best case scenario ability for the company to grow its business. So a lot of the times you will see a return on equity much higher than EPS growth because in most cases it is almost impossible for a company to grow its business at its return on equity. So next up we're going to go to sustainable growth rate. So I'll show you this formula here. It is 1, which represents 100, minus the payout ratio. So that gives us what I was kind of alluding to earlier. So 100% minus 36.44%, that's kind of your 64%. That is what percentage of the earnings the company has to do one of those things that I mentioned earlier. Buy back shares, mergers and acquisitions, reinvest in itself, or just simply sit on the cash. And then we're going to take that number, the money left after the payout ratio, times the return on equity, which gets you your theoretical growth rate. So that's kind of a way to mix in the payout ratio with the return on equity to give a more realistic growth rate, but oftentimes the sustainable growth rate will be much, much higher than what the actual attainable EPS growth is. But in this case, we're seeing that TROW sustainable growth rate is 21.07%, and over the last 3 years, TROW's actually grown its EPS by more than that sustainable growth rate. So that's why I like this company so much. Management is actually performing. They're living up to the standards that these kind of formulas set for them, and they're actually doing even better. So core growth rate, a lot of the times when I was saying that I thought the sustainable growth rate is much too high, I'll simply just use the company's last 3 years of EPS growth, annualized EPS growth, and use that as a core growth rate. So then that takes us to the optimal payout ratio formula. So I'll show you this one. And I throw the absolute on there. That's something we could talk about in later videos. But 1 represents 100, and then you're minusing it by the core growth rate divided by the return on equity. And that will tell you what the optimal payout ratio is. And then this missing dividend is the optimal payout ratio minus the actual payout ratio divided by the payout ratio. And that just kind of tells you, how far off is the company from actually paying how much it should be paying. So this is a great number. It's 0.5% away. And it's negative, so that means they're actually paying a little bit more than what this optimal payout ratio is telling you. So that's why I love TROW so much. They're yielding so much. Like, that's a 4% yield. Yeah, we got to look up the SPY. What is that yielding now? The SPY is yielding a measly 1.38%. And the way to kind of go about that, so what's that? How long is that going to take for you to get all of your money back? I'm doing the calculator right now. Alright, bear with me. Alright, whatever. We're just going to say, that's going to take you about 95, 92 years to get all of your money back. If the company had absolute no share price appreciation, it would take you 92 years to get your money back if you bought the SPY right now. That is absolutely insane. So, TROW is a little bit better. It's going to take you about 25 years to get all of your money back if the company never grew its dividend and you never reinvested any of your shares. So this yield of, let's say, 4% is almost 3.5 times larger than the kind of benchmark for the U.S. markets, the S&P 500. And then we look at the growth rate. That's how we know that we're going to grow our share count. We're going to grow the amount of money that we're getting paid. Those two factors are what I love. So then let's go back to this chart over here. The next reason I love TROW price is because in the last few months, it has seen this oversold on the RSI. If you don't know what the RSI is, I suggest kind of watching some videos on that. Over these next few months, I believe, I'll be putting out many more videos, so watch for an RSI video. I'll definitely be having one of those myself. But the only thing you need to know is that when the RSI goes below this 30 line, that means it enters its oversold kind of trading range. And that oversold range goes from anywhere from 0 to 30, and then the oversold range goes anywhere from 70 to 100. But the oversold isn't important because RSI is a momentum oscillator, And when T-Rowe goes into the oversold on the RSI, that means theoretically that it should stop going down. Obviously, everything works great in theory, but when you get into the actual, markets, things do not work that way. Many times you'll see companies go into this negative territory and not reverse, just keep going down and down and down. But anyways, let's go back. Let's go all the way back in time. And this is a weekly chart, by the way. That is my favorite way to do investing. And this is an investing video, not a trading video. Many videos to come on trading, but this is purely investing. This is buy and hold investing. So this is back to 1987. Here is probably the flash crash of 87. So let's go down here. So on this week, on October 19th, 1987, T-Rowe is in negative territory. Up here in the left-hand corner, you'll see it is at 25.85, so it's below that 30 line. So now we're watching. We gotta watch. We just gotta watch. We gotta wait, because I do not want to buy T-Rowe until it goes back above this green 30 line. So it gets here on the 19th. We keep going through November, nothing. December, nothing. Middle of December, nothing. Bam. December 21st, the week of, we finally get a level that is above 30. So we're going to put a vertical here. Next up, stock market went down a lot in the 1990 year. I believe there was a recession that year. So let's look at this one. So we hit a oversold level, 29.5. Not as extreme as the last one, but nonetheless still the same. It's oversold. Nothing there. All right, bam. We're gonna put a vertical here because we went over the 30 line. But then the next week we're back in it. Things are bad. We're in a recession. So here we bottom in October. We're going up, and back here on the week of November 12th, we finally get out of it. So 2 verticals there. Then we keep going. 1993, everything's dandy. 1996, everything's great. 97, everything's great. Things got kind of dicey in 98, but things are good. Same thing in 90, things are still good. Things aren't as great in the early 2000s, but we have not hit that oversold in a while. And here we go. This is when the market more or less bottomed from the tech bubble. So let's see. Week of July 8th, 33. Week of July 15th, 26. So we're going to watch this. Bottom on 22nd. 29th, real close. And then August. There's our vertical. And then as we see, these things kind of look familiar, right? This is the second time we've seen this kind of bottom and then another bottom come in. So this one was real quick, just a quick bottom, and then bam, a big move up. Things are good, things are going great. We make it to 2008, and then bam, things are not great anymore. Financial crisis. So 13th, that's the 32. There's our 27, October, things are a little bit better, and then October 27th we get our vertical, and then nothing. No oversolds here. Then we get a little quick dip into the August of the 2011, so 33, 28, there's our oversold, and then week of August 22nd, there's our no longer oversold, so we're going to put our vertical there. Next up, August of 15, that's the back-to-back August. Maybe that's something to know. Maybe there's some seasonality there, but who knows? We'll have to check it out. So oversold August 31st of 2015, and then September, good week. We get back out of oversold. There's our vertical. And then big run up here into 17. Little tiny dip here in October. Bam, there's our vertical. Here's the COVID crash at 20. Just a little dip in there. Bam, there's our vertical. And then now here we are now. March, there's a vertical. And then May 23rd of this past month, there's a vertical. So let's shut off RSI and let's go back to price. So let's get over here to 87. So T Rowe starts trading. This is its first week ever trading. This is the week of March 31st of 1986. I don't know about you, but I wasn't born yet. Let's keep her going. So here's our first vertical. We're gonna check it, make sure I'm not cheating. Here's your RSI coming out of the oversold. So big week up, huge week up. That's a 16.5% massive move in a financial stock. That is a bottom, folks. Then we're going across. You know, we got a little early here in 90. Let's see, we missed the bottom by, let's call it 20%, 30% maybe with this long wick. So you're gonna eat that one. You know, maybe you bought $2,000, maybe you bought $1,000, you bought 1,000, you're at 700, things aren't looking great. You know, you're probably like, damn, the strategy sucks, Jeremy's an idiot. But anyways, that's fine, because we get another one here, and there's your bottom. So I'm not that big of an idiot. Then we go for a long time. Damn, you made a lot of money through here. Going across. Okay, we get another bottom. And that was a chop fest, boys and girls. That is just brutal price action. You're getting stopped out all over the place. Huge volatility there. That kind of makes an inverse head and shoulder pattern. There's one. There's the head. There's the other shoulder. Breakout, but then nothing. It just falls back down. And then now you're looking at another a head and shoulder top. So there's your shoulder there. There's your head. There's your other shoulder. And we break here. Instantly reverses. Who the hell knows what's going on here? One day everything's great. That's your K-shaped recovery. Then next thing you know, we hit previous resistance, and bam, we're just right back down. And that brings us to our end of the bear market bottom from the tech bubble of week of October 7th. There is your buyable point, because as we know, the RSI came out of its oversold, and that's the one I missed. So we bought here and we bought here. So we bought the bottom and we bought almost the bottom. Then we keep going. That's the one that got moved. Then we get to 08. Everything sucks. This one isn't as great. You know, we missed this huge move. Between you and me, I'm probably buying in here too. Not at the bottom because the indicator did not hit an extreme. But I'm buying probably up in here. And that looks good. So we go back here. Here's your other one. That's 11. Everyone thought everything was going back to hell. We're putting in another head and shoulders topping pattern. There's one shoulder. There's the head. Oh my God, we're making another shoulder, and then it just never stopped. We just kept going. So then we get to 15. A lot of chop. Let's check this one. Make sure. A lot of chop through 15. Even 14. That is. Oh, even through 17. That is 3 straight years of chop, and we more or less picked the bottom there right before this huge move. That makes up for a lot of that chop. And remember, during this whole time, you're getting paid dividends. So even with this sideways action, that's the power of that dividend, is when you're not getting any price appreciation, you still have kind of guaranteed total return just through the dividend itself, even without dividend growth. So that's kind of what, you know, a no-brainer way for these dividend stocks to beat the S&P 500 over the long term. Next up, here's our 18. Here's the 20. That one is the bottom. And then it's getting a little loosey-goosey in here. We've had these 2 verticals because, like I said, this one has just been getting absolutely smashed. It is down almost 50% off the highs. You know, the markets are in turmoil, inflation is everywhere, but I am stoked. I'm getting ready to buy me a lot of T. Rowe Price, and I'm just going to sit on it. You know, this is like a minimum 15-year investment right here. And this is just one of the many investments I'm doing. You know, that's why I kind of feel confident that I can just hold this one and ride it out. Obviously, many great companies have gone to zero. Many great companies have underperformed. But there also have been many stocks that have done well for, you know, very long periods of time. I'm talking, think of your Procter and Gamble's, think of your Coca-Colas, think of your McDonald's, you know, to a more extreme set, think of your Microsofts, which has gone through a fair share of its bear market woes. Think your Apples, which has gone through a fair share of your bear market woes. But that's the power of diversification. You know, one stock going to zero shouldn't completely bankrupt you. It shouldn't absolutely put your retirement in just turmoil. Um, so something to think about. That's why I like TROW. And thanks for coming to the first video.